now to David Morrison, Senior Market Analyst, Trade Nation, joining us from London. Good evening from India, and thank you so much for joining us. Given the FOMC's recent decision to hold rates steady at 4.25% and 4.5%, what are your expectations for the next move? Will the Fed cut, hike, or maintain rates through the rest of 2025? And what data points will be most influential in that decision?
Well, this is absolutely key. And as you so rightly say, there's no the expectation is 99.9% is the probability of no change tonight, according to the CME FedWatch tool. Now, however, this is a very important quarterly meeting. It's when the FOMC members also come up with their quarterly summary of economic projections. And within that, they give their forecasts for the rest of the year and beyond for GDP, unemployment, the Fed funds rate, and inflation. Now, looking back at March's SEP figure, back then, the dot plot, which is also part of it, suggested that FOMC members expect possibly 2 rate cuts before the end of this year. And basically, that is what the market is also looking for, with the first one probably in September, and then the possibility of a second one maybe by year end. So that's the sort of thing that markets are looking for at the moment. At the moment, they're going along with exactly what the Fed said back in March. So it'll be very interesting to see if anything changes in the summary of economic projections tonight. It'll be very interesting to see if the FOMC favor keeping their forecast at 225 basis point rate cuts, or maybe they deviate away from that. And the big question is, which way may they deviate away from that? Because a lot of analysts are privately or publicly, in many cases, saying that there may be 1 rate cut by the end of December, by the end of this year, or possibly none whatsoever. But the Fed are going to be very aware that there has been, although it's very early stages, there has been a slight softening in the employment data. That is to say that jobless claims, the weekly jobless claims, have been ticking higher a touch. The last non-farm payroll figure wasn't great. There were some revisions, and it wasn't a blowout figure like some have been. And at the same time, we have actually got inflation, especially measured by core PCE, which is the Fed's preferred inflation measure. That has come down quite sharply from 2.9% in February to February to about 2.5. I beg your pardon, 2.9% in March. I think it was to 2.5% in April. So what May's figure says is going to be very interesting indeed to see if we get that coming down further towards target. Although Jerome Powell has said previously that the Federal Reserve won't wait until they get to that 2% inflation target to cut rates. And we've seen that already, because they cut by a full basis point in the last 4 months of last year. So I think, yes, it's going to be the inflation data that's important, but also I think employment. After all, that is the dual mandate that the Fed has to ensure price stability while maximizing employment.
Sure. David, let's talk about what's happening in the world, because we can't really ignore that, right? Instead of a clearer path laid out ahead, Jerome Powell and his peers sat down to news of increased geopolitical conflict in the Middle East, potentially pushing up oil prices, as well as ongoing uncertainty over tariff agreements with key partners, a downgrade of US credit by Moody's. So how are ongoing geopolitical tensions, such as the Middle East conflict and these new tariffs, factoring into the Fed's policy calculus and your own market outlook?
Well, I think they all give Jerome Powell and the rest of his FOMC members the excuse not to rush in to cut interest rates. And that's probably sensible. I mean, although the data is now sort of moving to suggest that a rate cut would be certainly helpful, and it's as far as President Trump is concerned, it's well overdue. Of course, all these other factors must play into the decision to some extent. The Fed just don't go by certain measures and say, right, that level's been hit. It's safe to go ahead and cut again or whatever. They have to take all these things into consideration. Now, on the tariff front, it is relatively early days to really measure any inflationary effect that they may have, because, of course, they've been postponed on a number of occasions. We haven't seen the full effects of tariffs come through. But nevertheless, there's sort of early signs that it may not be as inflationary as first feared. But as I say, we're still a bit of a way to go before that. We've got all the trade negotiations still ongoing, but at quite a relatively slow pace considering the deadlines that we've got involved here. But chief out of those, of course, is anything that goes on between China and the US. And the market was quite relieved to hear that when they had the meeting, when there was a meeting between the US and China, it seemed to go quite well, and there was some rapprochement, some agreement on both sides. Nothing's been finalized as far as I'm aware yet. There must be some more things to iron out, but there's progress, so that's good. As far as geopolitics are concerned, yes, I mean, this is another thing that the Federal Reserve have got to be very wary about. They may mention the geopolitical uncertainty, they may consider the oil price, although what I would say is that as far as their preferred inflation measure goes, core PCE, that excludes volatile items like food and energy. So I'm not quite sure how much emphasis they'll put on the geopolitical situation.
David Morrison, Senior Market Analyst, joining us all the way from London. Thank you so much for your time. Of course, the elephant in the room will be President Donald Trump's reaction if the FOMC once again refuses to heed his wishes in cutting the base rate, a comment that he's just made right now, despite the FOMC highlighting increased uncertainty around both inflation and unemployment. David, thank you so much for your time.
Thank you so much.